Did accounting rules cause Silicon Valley Bank to blow up? Well, of course, we all know that SVB blew up for a number of reasons. Obviously, interest rates rose and management had taken a lot of bets, long term bets on securities that had a lot of interest rate risk, even if they didn't have credit risks. But did the way we account for securities held by banks at least contribute or enable SVB to take oversized risks, let's say? And just how bad is this problem? Are other banks doing the same thing too? Hint, hint, they definitely are. And what should we do about this? I don't have all the answers. I'm just your host, but I have someone here with me who might. His name is Joao Granja. He is a professor of accounting, associate professor of accounting at University of Chicago's Booth School of Business. And he just published a paper very quickly, I might add, a working paper about this very issue. So Joao, thank you very much for joining us. And I look forward to diving in.
Yeah, it's my pleasure to be here. Yeah.
So you did something that is rare in academia. You published something really less than a month after the thing was in the news, which I applaud because that's not very common. And you found essentially, and let me explain this to the layman. And if you're in the audience watching, please bear with me because there are a few sort of ground rules we need to establish before we dig into a topic like accounting, which doesn't sound like fun, but actually it is. Promise me. And Joel, please correct me if I misspeak. But roughly a fourth of bank assets right now are held in securities, and those can be in one of three different buckets. Trading securities, which are just mark to market, and they hit the income statement very simply based on the up or down gains. Available for sale securities, or AFS, those are also mark to market. Those are sort of not quite the day-to-day trading stuff. Those are held for a little bit longer, less than a year. They aren't hitting the income statement directly. They go to something called other comprehensive income, which is this kind of weird category. It's still on the statements, but it's sort of out of mind a little bit until they're sold. And then when the gain or loss is realized, then that it actually hits the income statement. And then there's a third category called held to maturity, HTM. And this is basically designated based on the bank's intent and ability, I should say, to hold the security to maturities. The idea is you're going to buy a long-term bond, and maybe the market value is going to go up and down throughout that long term. If you're literally really holding it to the end, in theory, you don't care about that market value going up and down, in theory. And so you can record that at essentially the original cost, adjusted for repayments and maybe changes in credit risk. And banks, importantly, have the ability to choose how they want to account for new securities coming in, and they can also reclassify. Have I got it right? And is convenience a problem for banks?
You got it completely right. So basically, I tend to joke with my students. So available for sale, it's a category where basically you're supposed to market the securities, the assets on the balance sheet, meaning that they will reflect the current market price that you basically see for these assets right now, for these securities right now. But the unrealized gains and losses from these securities are going to eat this other comprehensive income, which is kind of, I jokingly tell my students, it's kind of the ugly duckling of accounting. It's not really something that is going to eat the net income, and it's going to affect the earnings per share that the banks are reporting, but it's going to affect this other category, which is not quite as noble as the net income. But it's
all the weird stuff goes into OCI, right?
Exactly.
Every weird, yeah.
It's still affecting the equity of the company. It's just sort of nobody pays attention to it. It's only when the securities that was available for sale securities are actually sold do these unrealized losses actually become realized, and then they eat the net income. So I tell my students, look, like it's actually the ugly duckling then became a beautiful swan.
I like that analogy.
So basically, but the banks also have the other option, right? And the way you pose it is exactly right. So they could basically classify the securities as held to maturity, and again, the idea is, okay, we're going to hold it until maturity, and we're going to get what we paid for in the end. So because we're holding it to the maturity, we're going to get the yield that we locked in when we bought it. right? So as a result, why should our net income, why should our balance sheet reflect any sort of volatility that we see in the meantime? So when we don't want that, because that basically affects also the quality of our earnings, the quality of our, and the ability of our shareholders to gauge performance, because that's going to be basically going to be a lot of things moving up and down. So we rather sort of insulate our balance sheet and net income from that sort of volatility, and classify this thing as held to maturity. So critically here, in order to basically get this treatment, banks do really have to basically to state that not only do they have the intent, but also they have the ability to basically hold this thing out to maturity. Otherwise, they might actually be forced to sell before these things get to their maturity, and then a torpedo might eat their net income, right? Um, and so basically this, I think this is something that nobody really paid a lot of attention to, like in the past 20, 30 years, like this idea that, because this hasn't been a problem for such a long time, right? But the rule is clear: the banks do have to have the ability to maintain this. So that's basically sort of what generated my research idea. What were the banks that basically reclassified securities from available for sale to held to maturity in this cycle of monetary tightening in 2022? Were those the banks that actually had the ability and just wanted to insulate the balance sheets for this volatility? Or do we actually have another kind of a problem, which is, well, actually, it was the banks that were the least able to hold this security until their ability, until their maturity, that decided to basically do these kind of things. Why? Because they just wanted to avoid marking those losses.
And that's exactly what you found, right? I mean, and just to back up, I mean, I intended to lose 5 pounds last year, but I didn't. My intent was different from my outcome. And I think Silicon Valley Bank, to take a specific example, probably intended to hold its treasuries and its mortgage-backed securities to maturity as well. But nobody can anticipate a bank run. And actually, Luigi Zingales, I don't know how well you know him, but he and some others, Nazkunt and Tano Santos, I believe, published a paper showing how much less sticky digital deposits are than old-fashioned bank deposits. So in other words, in this age, it's so much easier for the money to leave the bank. So in other words, if I'm a CFO at a bank and I intend to hold something to maturity, how would I even know if I have the ability to, if the deposits can move around so much faster?
Yeah, and what you're basically touching upon now, it's a critical issue of what's going on, right? I mean, I would actually split your comment into two parts. First of all, there's issues about how flighty these deposits are, even in terms of whether they were insured or uninsured. Uninsured depositors are naturally going to be much more flighty than insured deposits are, right? So those are the ones that, once there's a seed of doubt that the bank might be in trouble, they will immediately sort of get their money out, right? So because they're gonna panic, they don't want to basically take a loss, they don't want to take a haircut, right? So basically, they are gonna get their money and sort of put it somewhere safe. Um, but then the second part of what your comment, and basically the paper of Luigi Zingales, basically that basically brings along something which is even more sort of, is something that is now becoming sort of a potential fault line, which is, up until now, we have always thought that even insured depositors are sort of, they're going to be sticky, right? And that's good for banks because it creates a natural edge, right? The asset side, okay, rates are rising. The asset side, the bonds, the securities, even the loans, they are losing value, right? Because they have the structure of a bond. When rates rise, basically the value of the bonds goes down. But it turns out that if the depositors are not demanding higher rates as well, so it turns out that the value of the liability side of banks also increases, right? They basically are able to basically, even though the rates are rising, they are able to have a funding situation in which they are paying very low rates, so they are getting this spread on the deposits. Now, here, the paper of Luis Zingales is going to be super influential because I think what it's doing is showing that perhaps nowadays, with the advance of digital technologies, depositors are not going to be as sticky as we thought them to be in previous crises. And that's going to create problems and fault lines for the banking system that perhaps the banking system is not yet ready to respond to. So it's in some way it's going to destroy this natural edge that scholars think that
Mhm.
banks always had and might not. Silicon Valley was a little bit different, right? Silicon Valley was sort of the first type of problem. It's not even that their sticky depositors are not sticky anymore. Silicon Valley just didn't have six sticky deposits. All
In
of
the
them
first
were
place, yeah.
uninsured. They ran. Yeah.
Yes. So, and I want to get to you hinted at something very important. I want to get to that in a minute and possible solutions. But just speaking of SVB itself, so I'm just reading from this rationalwalk.com. The equity coming into 2023 for SVB was $16 billion, but it would have been 852 million had its held to maturity securities been marked to market. Now, I don't want to make this interview just about Silicon Valley Bank. So let's back up to your overall paper. Can you give a sense of the scale? Like how much are banks making use of this ability to reclassify or to questionably classify stuff as HTM, maybe to kind of at least get it out of sight, out of mind?
So basically, what I find in my current version of the paper is that throughout 2021 and 2022, banks actually, as in aggregate, they've basically reclassified half a trillion of securities from available for sale to HTM. So obviously, I mean, given the monetary tightening of 2022, that basically, I mean, that's gonna amount. I don't have those calculations, but this is gonna amount to basically crystallizing a lot of potential losses that weren't then didn't hit the balance sheet or the
And that's like a
statement of the.
quarter of their assets. I mean, what's the half a trillion compares to what overall size of the
Um,
portfolios?
But well, I mean, I can tell you that it compares to a total portfolio of available for sale securities and held to maturity securities of 6 trillion.
6 trillion. Okay, so it's
So
material. Yeah,
they basically, yeah. So I think they basically moved approximately 10% of their total securities from available for sale to maturity, and so they then crystallizing losses on approximately 10% um, of their balance sheet securities.
got it.
Yeah, actually, in my updated version of the paper, which is probably going to come out very very soon, I was telling you before, sort of I meant collecting some data from public banks, and I actually think it's going to be it's actually more than half a trillion. It's going to be something in the ballpark of perhaps zero point 0.7 trillion. Yeah.
Yeah, I remember you noted you might have understated things in your paper, and a lot of banks don't use HTM at all. A good many of them don't. So that means that some are really using it, and you found, and you can elaborate here, but it was generally the least creditworthy banks, the banks that are most vulnerable to bank runs, the banks that had the most to hide did the most hiding. And I'm assigning a motive when I say hide. I should be more careful with that, but
Mm-hmm.
they at least made the most use of this ability to
Yeah.
classify at will.
Yeah, and that's basically sort of what I set out myself to do, was exactly to try to understand who are the banks that basically are engaging in this sort of behavior, and I mean, sort of, and the suspects would be, well, exactly those banks that rely a lot on the deposit funding structure that was more flighty, banks that expose themselves a lot to this interest rate risk. I mean, this interest rate risk is going to be much higher if the bond is a very long-term bond. They're basically exposed to a lot of duration risk, meaning that the value of these bonds are going to vary a lot with a 1% increase in the interest rates. Which is what is especially problematic is actually a combination of the two, right? High exposure to interest rate risks with a lot of exposure to flighty depositors.
The worst combination. Yeah.
And it turns out, which is sort of, I would call that the Silicon Valley combination. It turns out that the banks that were much more likely to reclassify were exactly those banks, the ones with high interest rate risk exposure and with a lot of flighty depositors. So, and it's not even close, right? So these banks were significantly more likely to reclassify into HTM, and I would arguably say that they are also sort of the ones that were the least able to hold these things until maturity, because they were just at the cusp of something, an information, a sort of a panic to basically rise. And at that point, basically depositors would fly, would basically get their money out. When that happens, they have to realize the losses, and they're going to be critically. I mean, these losses are probably going to put them underwater. And
Yep. And usually we think of accounting as describing an economic situation. When accounting starts to motivate economic behaviors for accounting reasons, at least I start to get a little nervous. So looking forward, Joao, to a solution. Some people have said have the Fed hold deposits. Some people have said have the FDIC guarantee all deposits, which may almost be the case anyway. Some people say it was a mistake to roll back some of the Dodd-Frank provisions, or raise the threshold to $250 billion in assets, up from $50 billion in assets at certain, which stress tests and certain provisions kick in at a more toothy level. How do you look at all that? I mean, there are a lot of different possible solutions. There's still drama between. I mean, if you show the market values on banks' financial statements, that would show a lot of volatility, right? What is the solution here in your mind?
I mean, obviously, I mean, it's difficult to have the solution. I think, like, I do think that in this case, going back to, I mean, what I'm seeing from my research, there's certainly an opportunity to perhaps revisit some of the things that are happening in the accounting standards, right? I mean, I do feel like I actually went and looked for sort of the inspection reports that the regulator of the auditors, the PCAOB, does to the auditors. And one interesting thing that I found is that the regulator of the audits criticizes a lot, for instance, the fact that the auditors are the way they are collecting data or inspecting the valuations of the securities, because some of these valuations are actually very difficult to do, right? I mean, some of these securities have very liquid prices. And so, for instance, the regulator of the auditors is going out to the auditors and say, well, you're not doing your auditing job properly, okay? But in the past couple of years, I haven't seen a single instance in which the PCAOB actually told the auditors that they are not sufficiently scrutinizing these accounting treatment of hold maturity, and especially scrutinizing this ability to hold. So I think this is something that, I mean, from the standpoint of accounting standard setters and from the private auditing profession, we probably will want to basically pay a little bit more attention to. And then also, still from an accounting standard standpoint, I think, I mean, we might have to discuss hold to maturity as a whole, whether this is an accounting treatment that banks should be allowed to use. I mean, to me, it is true that the fact that hold to maturity, that Silicon Valley and some other banks were using hold to maturity, what is created was that rather than these problems that were sort of brewing in their balance sheets becoming sort of coming to the daylight, let's say in the second quarter of 2022, the problems were somewhat, I mean, they basically lurked underneath. Nobody really sort of saw through what was going on until probably they actually were actually too large for someone to act upon them. I mean,
Yeah.
at that point, sort of no one would basically want to basically put capital on those banks.
And they were in the footnotes. Those problems were in the footnotes, right? But nobody reads the footnotes.
Yeah. Well, I mean, it's a very salient footnote, and that's one of the big puzzles in all of this. Is like, I mean, I do saw some tweets and some sort of investment houses discussing how that this was probably going to happen. So I do.
Yeah, there were a few people. Yeah.
There were a few people that sort of saw the problem. Is that it basically it didn't create sort of shockwaves that were large enough for Silicon Valley to act upon them sooner rather than later. So
Well,
yeah.
let me ask you this. So about just bank reporting writ large, and just stepping back a little bit, if you look at a bank 10K, it's huge. And then it's got appendix and appendix to the appendix, and there's so much stuff. and it's so easy to miss things. So it's in a way, it's not surprising that to me that as an investor, I was at a hedge fund years ago and I ran a research department. So I come from the investor side, and there's just so much material that it's not surprising that certain details get missed. Now, obviously, right now everybody's going to be watching this footnote. So this particular thing is probably not going to be missed, but there might be the next thing that's missed. Do we have too much information now in bank reporting?
I think I'm not sure. Like the information is there. I mean, at least we cannot sort of fault the system for
Mm-hmm.
basically obfuscate and sort of. I mean, the information is actually put out there. Even as I told you, like I'm currently sort of hand collecting all the information about reclassifications from AFS to HEM, and all of that is sort of available out there. I think perhaps one of the things that is kind of might be a little bit problematic is that I do think that we lost a lot of institutional memory
Mm-hmm.
regarding this sort of crisis, right? I mean, the last one that we had along these molds was the savings allowance of the late 80s and early 90s. Um, Sort of, and as a result, probably the last time we had to deal with investors, but also regulators and auditors, all the last time we had to basically deal with something like this was 30 years ago. The 2008 crisis was mostly a credit quality crisis, and back then we were all worried about, oh, level 1, level 2, level 3. Why are these guys valuing these assets as level 3, sort of mark to model assets? Are they trying to hide something? And all this information was out there, and sort of it was sale and everybody was using it. I do feel like 30 years ago was a long time, and sort of we
A
perhaps
generation ago, really.
we just forgot that interest rate
Yeah.
risks probably might be something that might actually drive a bank underwater. So I mean, even if you look, for instance, at the regulatory stress tests, the regulators didn't actually feature a sort of a scenario that basically took into account increase in interest rate risk. Another thing which is actually sort of funny, and I wanted to sort of tell you about this, is the the Office of Risk Supervision, which was extinguished after the financial crisis in 2008, was actually initially created in 1991 to deal with the savings allowance crisis. If you look at the thrift financial reports, which was a special call report for the savings banks, it's funny that they have a section on interest rate risks, which was way more advanced than anything that the current regulatory call reports have.
Yeah.
The problem was actually sort of that the Office of Street Supervision became a lenient regulator over time, because they started sort of losing charters, they started losing business, and they become catering more and more to their regulated entities, the banks. And actually, still the largest bank failure ever was under their watch, which was the Washington Mutual in 2008. And so basically, they were extinguished. But I do think, which is interesting, there was a lot of institutional capital in that particular part of the report, which came from the fact that they were basically created to deal with the savings allowance crisis in early 1991. So that specific sort of section of the report basically disappeared once they were extinguished, and definitely something that would have been of use now, that to calculate sort of the exposures of banks to this kind of things. So it's kind of
What's the
thing.
saying? If you cannot remember the past, you are doomed to repeat it.
Mhm.
Right. So yeah, economics is a social science, and humans are social beings, and we're just humans, and we forget. It's an excellent
Yeah.
point. Um, so the paper is called Bank Fragility and Reclassification of Securities into HTM. I highly recommend you guys check it out. Joao, thank you very much for joining us today. If somebody wants to learn more about you, your research, where would you send them?
I mean, you can always go to my website, and which is not updated with the paper yet. I will do that very soon. And but you can also basically just go to my SSRN page and just
Okay.
check out what the kind of work I do.
Just search your name at SSRN, Social Sciences Research Network, and it'll come up. Thank you so much for joining us. It's been a pleasure. I
You're
certainly
welcome.
learned a lot, and I hope you guys watching at home learned a lot too. And thanks for watching.
Thank you.